Hi, I'm Linda Eedes, and today I'm going to be giving you an update on the RECM Global Flexible Fund. The market environment has been very volatile of late. There have been prices all over the place, and it really sort of feels that the market doesn't know how to price assets right now, if you look at the sort of jumps in prices one day to the next. And that's a very uncomfortable sort of market to sit through as an investor. But the good news is that as active investors, that's precisely the type of market that you want. As an active investor, you believe that you can beat the market because the market will at times misprice assets. And you can take advantage of that, and at some point in the future, the market will recognize the actual worth of those businesses. So as value investors, on top of being active investors, this is the kind of market environment we look forward to, where increasingly so we are finding more and more opportunities to buy businesses as the sort of broad weakness continues at good prices. So looking at the overall portfolio, it's positioned very well for this kind of market environment. So first of all, the fund has got quite a bit of cash. Now, it's got about 20% in cash. Most of that is in offshore cash, which has obviously been good for the fund. And the reason why it's good to have that cash is, first of all, it provides you with a buffer if you do have market weakness and broad market declines. But more importantly, it gives you that dry powder to actually buy businesses at good prices when the market gives you the opportunity to do so. Secondly, the portfolio is becoming increasingly well diversified. You'll know that one of the most compelling opportunities that we see in the market today, which has been the case certainly over the last 2 years, is within the resources and cyclical space. And that remains the case. We still think that there's a once-in-a-generation investment opportunity in that area. But as the market has sold off broadly, it has given us the opportunity to buy businesses outside of that space where there has been price weakness as well. So we still sit with about a third of the equities in resources, and in particular there, we really want to make sure that we're in the businesses which are going to survive the cycle. So we want businesses which are well capitalized, which don't have excessive gearing, which have the best assets. In other words, they're the lowest cost producers. So even with low commodity prices, they will weather the cycle. They're actually still making money. And we want to make sure that we're in the highest quality resource businesses in the marketplace today. So that's the proviso with regards to where you want to take your exposure in the resources sector. And over the last quarter, we did have the opportunity to switch some of our exposure in resources into companies like BHP Billiton on the global side and locally Sasol. So we've got a slightly more diversified exposure in resources, but still significant exposure to that sector. We've also been able to, as I say, diversify into other sectors, particularly into areas like the financial sector, where, of course, with the whole Nenegate situation last year, we saw that sector coming under quite a bit of pressure, also with the expectation of increasing interest rates. And we have increased our exposure to companies such as Nedbank and Standard Bank locally, and then to some financial companies globally as well. So we sit with a portfolio which is very well diversified, but still taking advantage of the compelling opportunities which we see in the marketplace today, but which also has quite a nice position in cash as a buffer, but also as ammunition to take advantage of opportunities as they come around. Thank you very much.